AT&T, stock ticker T, recently released their earnings report where they beat actually on the top line and the bottom line. As you can see here, EPS of 64 cents, revenue of 30.35 billion, also beating by 2 cents on the EPS and 110 million on the revenue. Coming down here, we can see it actually a quite nice revenue beat, 1% year over year, and also reported, which is I think is more interesting, a 5.2 increase in free cash flow to 1.3 billion year over year, and expect a full year free cash flow of around 16.5 billion compared to the prior guidance of 16 billion or better. Because one of the main reasons you are buying AT&T is for the dividend. They offer a pretty nice dividend, to be honest, and it is all about that free cash flow to actually sustain the dividend. So in this video, I want to take a closer look at AT&T, also suggest if there should be a dividend cut or not, or if the dividend seems to be safe, and also talk about some of the problem area I see with AT&T. So let's get right into it. As you can see here, after they released the earnings report, AT&T actually jumped quite a bit, up 7.7% over the last week. Year to date, they are down roughly 18%, but then again, a lot of stocks are down. Zooming out a little bit more, 8% down, which isn't looking too good either. I mentioned that the dividend is quite nice, and as you can see here, they offer a 7.22 dividend yield, annual payout of 1.11, payout ratio of around 45%, but a negative growth rate over the last 5 years, and thus haven't grown their dividend for any years at all. Taking a closer look at how it has performed versus the S&P 500, you can see over the last 5-year period, while the S&P 500 is up around 50%, AT&T is actually down 37%. And just zooming in year to date, as we can see here, it's down, as mentioned, 18%, while the S&P is up still around 10%, even though it has gone down a little bit over the last month or two. So as mentioned, I definitely see this as a stock you mainly buy for the income and those 7.22% in the dividend yield. If we look at the dividend history, you can see quite recently they got a dividend cut a little bit from 39 cents down to 28 cents just in the middle of 2022. As mentioned, AT&T actually beats most expectation on the revenue side, and if we jump into the financial statement, you can actually see here that it's gone up a little bit compared to the last report back from December, so the trend is definitely in the right direction. Not as much in the glory days back a couple of years ago, but still it is indeed moving upwards instead of down, and that is indeed a major good news for AT&T. Jumping into the cash flow statement, while the net income is negative, we go down here a little bit to the cash from operations. You can see here 37 billion, up also from the last report back in December 22. Capital expenditure has gone down a little bit to 17 versus 19, also looking extremely good. So what we can see is roughly $20 billion in free cash flow, which is nicely with the guidance around 16.5. So it's most likely to go down a little bit when the last reports come in. And if we go down here a little bit to, you can see back in the bottom, you can see free cash flow per share 2.76, which is way better than the $1.11 dividend that's paid per share. One big issue with AT&T is the ever so high debt they have. And if we go up here a little bit to find out, they are actively also, you can see total debt repaid. They are actively trying to pay it down. They have paid a lot of money over the last, so up here we had a little bit of a bad year doing after COVID, but then again, they have roughly 50 billion for roughly 50, and now again also 22 billion. So this is extremely looking pretty good. This is the last 12 months as mentioned. So we are most likely hitting roughly the same amount every year. So they are actively trying to bring the leverage down. And one thing we also want to point out here is the common preferred stock dividends paid, $8 billion. And if you remember, the guidance should be around 16 to 16.5. So there should be plenty of free cash flow to cover the dividend. So I don't see any way they are going to cut the dividend again. It seems to be perfectly safe around a 50% payout ratio. But before we jump into our intrinsic value calculator and also the stock screener, I do want to take a closer look at how the analyst from Wall Street thinks about AT&T. As you can see here, they actually have it rated as a buy at the current time. 28 analysts covering over the last 90 days, several on the strong buy, but also a few on the strong sell position actually. Most of them sits at a hold at the current time. If you come down to the price target, you can see the average price target sits around 18.5, roughly a 20% upside from the current levels. But let's jump into our stock screener and take a closer look at some of the key metrics and intrinsic value of AT&T. As you can see here, we do have a lot of the different metrics and some we would like to take a closer look at. So what we immediately see is that the EPS growth is negative. Obviously, we would like that to be positive because that means that the company is growing and evolving and would probably be a pretty sustainable business into the future. The PE ratio sits below the 5-year average, which is also pretty good because that seems that is a pretty good buying opportunity at the current levels. Revenue hasn't really grown that much, but we have taken a close look at that. That is on the verge to on the trend up again, which is pretty good. The net debt to EBITDA, if you follow my videos, you know I would really like this to be below 3, and it sits just above. But as we saw earlier, they are actively trying to bring down their debt and leverage. So I think in a couple of quarters time, this definitely should come below 3. Would probably make it a better investment at that time. If you take a closer look at the return on invested capital, return on equity, I also think it looks pretty okay. Analyst target price have we discussed. Short interest is pretty low still, so I think that is okay, which could indicate a little bit of sentiment between investors that it should move upwards in the future. As you can see here over on the margins as well, I think they also look pretty okay for the most part, and definitely this one, operating margin growth over the last 5 years, actually 4%, which is pretty high for a company as established as AT&T. For some reason, the dividend payout ratio wouldn't really load here, but we know it is sitting at a healthy 45%, so we don't really want to touch that at all. Going into here, and let's zoom in a little bit into the dividend data tab, what we really want to see here is indeed some steady growth. We just saw earlier that AT&T had a dividend cut, so obviously this will look pretty bad. But I think in the future we'll see some steady growth, but they will probably keep it around these 2% per year. But if you do come down to the dividend yield theory graphs, you can see here that it actually is in the red according to the dividend yield theory. Could indicate that it's not a very good buy at the current time. But let's jump into a different valuation model so we can take a close look at the intrinsic value. I don't want to go through every one of them. So if you do want to take a close look at some of them, for example, the discount cash flow model here, and see all my estimations, you can always pause the video. I have used a very conservative growth rate of 3% going into the future for the free cash flow. We obviously also have the dividend discount model, the multiples valuation, the Graham's revised valuation model, which is negative, the price to earnings valuation model, where we take some of the last year's price to earning and then try to gauge an intrinsic value based on that. Free cash flow valuation, where we kind of do the same thing. Also the Peter Lynch model, where I do have a video on my channel where we go through to automate this model actually, if you want to take a closer look at that. Before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel for more videos in the future. Let's jump into the summary where we do have all our valuation models. As mentioned, I have excluded some of them, for example, Graham's and multiples, since they count on EPS, and that is negative in this one. So in this case, we will just use the remaining ones. And the average intrinsic actually gets to 18.79, which is roughly in line with the analyst target price, as we saw earlier. Could indicate a 20% upside from the current levels. Jumping back here, as you can see, the current price being 15.38, it could average discount, current discount could be around 18%. We obviously also want to apply a margin of safety, as we always do, because we are value investors. We start with standard 25, and then based on some of the different metrics here, we either add or deduct a little bit of margin of safety. And since this one wouldn't load automatically in, we do have to calculate this ourselves. So we take 25 minus 10 minus 5, that is 10, plus 5 plus 5 plus 0 minus 5, so we are back down to 15. So using that 15% margin of safety, we go over here and punch in margin of safety 15%, which brings the acceptable buy price down to 15.98. Current price being around 15.38, there should be an acceptable buy price actually at the current levels. So even with this margin of safety, I still think it's a pretty okay entry point actually from the current level, if you do believe in the company on the long run at least. And obviously you do need to pay attention to some of the pitfalls that are with AT&T, such as the leverage, and also that is mainly for the income from the dividend you are going to buy the stock. It will not be a 100 bagger suddenly. I don't think AT&T will ever find that growth anywhere, to be honest, unless something extreme happens in the world, which obviously has happened a lot of times over the last year. So I think it's probably a pretty safe bet at the current levels. But obviously I do want to have you to watch the massive debt burden, because it is indeed pretty high. The leverage is high, but they are actively paying it back, as we saw. So if you are a bit more on the safe side, maybe watch a few quarters or two to see whether or not the debt will be relieved even further or paid down more, so that you feel that you are a bit more at the safe spot. Also with interest in the world and macroeconomic environment and so on, it could be for the more conservative investor to actually take a few steps back and watch the stock a bit more before buying. Personally, I do think that the current levels is a pretty good entry point for AT&T if you wish to buy into the company. Thank you so much for watching, and I'll be seeing you in the next video.